Now let's deal with my definitions of risk, financial risk in particular. So risk in general is just uncertainty in the value of some random variable at some time in the future. A random variable is different to a deterministic variable like time. You know that day 5 follows day 4, or Tuesday follows Monday. So that's an example of a variable whose value is known in the future. But a random variable or stochastic variable is one whose value is not known in the future. So risk is the uncertainty in the value of a random variable at some time in the future. Financial risk is the uncertainty in the value of a portfolio at the risk horizon, as opposed to the investment horizon, which is a different type of time in the future. So just to consolidate that idea, let me just show you a little drawing that I've made. What would it be? This one. Yeah, you can see here a little drawing where here we are now, time 0. There's I, a little I, and this is the value of, say, a portfolio of shares. Say it's £10,000 or something like that. So this is the market price in pounds of shares. And over a period of time, say 10 days or so, that portfolio price can go up, down, down and up, and it can go sideways. Most likely, it's going to not have much of a trend, so you might expect the future value to be the value it is today. Most of these thousands of possibilities which end up here, we drew a histogram. We could then get a distribution at some time t here, and this is the distribution of the random variable, which is my portfolio value in the future. And that future time would be, as I said, the risk horizon. The risk horizon is typically 1 or 10 days for market risk, but much longer, something like a year for credit risk. And the portfolio would be anything from holding shares in just one stock to having hundreds of positions on various financial assets and financial instruments. We'll talk about that later on in the second section here, the financial assets and instruments. Investment horizon is the horizon that really applies to portfolio managers, or asset managers as they may be called. That's the time period that an investment is held for. It could be short term, medium term, or long term. And depending on the speed of the market, long term would typically be something like 10 years. Certainly for something like bonds, whose prices tend to move very slowly, it would be many years, maybe 30 years. Medium term is anything from 6 months to a few years, but short term could be days or months. At the opposite end to bonds, we have things like crypto markets, which are hugely volatile and prices move very quickly. And so in these markets, short term would just be hours or just 1 or 2 days, whereas long term would be 6 months or maybe maximum a year. The investment horizon also refers to the time over which asset managers report returns to their investors. If it's a hedge fund, it would typically just be a month. They do it very frequently. But for pension funds, it's usually just annually. I mean, I get a report of the USS pension value that I'm saving up once a year. And my ex ante returns they are forecast under different scenarios, but mostly I just get the reporting of last year's return. In other words, ex post. And I don't get a risk-adjusted Sharpe ratio or Sortino ratio or omega ratio. There's lots of different ways in which one can adjust returns for risk, because if you have a high expected return, that usually comes with anticipated higher risk. So a Sharpe ratio, for example, is the expected return divided by the risk, as measured by the standard deviation, and then annualized. We'll look at annualization in detail later on in topic 3 of this module. Main categories of financial risks are market, credit, operational risk, as I mentioned before, and I also choose to distinguish liquidity risk and basis risk. We're going to be really looking into detail at market risk and credit risk. So market risk is the financial risk arising from changes in an interest rate or the price of a financial asset or instrument. Interest rates are not financial assets. Bonds are, but not interest rates. They don't have a market cap. Like bonds or shares, they have market cap. Instruments such as futures, options, swaps, they don't have a market cap either. They have a notional value. So they are not financial assets. Credit risk is the uncertainty in the value of a portfolio of bonds or loans or swaps usually. And there are two sources of credit risk, one from the default of an obligation. For example, I may be a bank that has given a loan to a company, so they are obliged to pay back that loan to me. I'm the obligee and they are the obligor. But if the company goes bust, they default and I don't get the loan paid back. So I make a loss. Or the uncertainty in the value of a portfolio arising from a change in credit rating. Maybe I've bought an A-rated bond and then it gets downgraded by Moody's or S&P or Fitch, one of these rating agencies, so that it is only a double B rated bond, so its price will go down and I'll again make a loss. Liquidity is just simply the risk that a transaction cannot be made, and there are again two types of liquidity risk, as we'll see on the next slide. Operational risk is the risk of loss associated with any non-financial matter, including reputational issues. I know ChatGPT distinguished that, but it was wrong on other schools as well. And normally reputational risk, regulatory risk, in other words, there may be a change in regulations that means you make a loss. These are all included in non-financial matters in operational risk. So again, there are two types of operational risk, as we shall see later in this video, and then basis risk. Basis risk is the risk arising from imperfect hedging. Risk cannot be eliminated completely. You can mitigate it very substantially by hedging your position. You can almost eliminate all the risk, but not quite. Usually there's some residual risk left, not always, but usually, and that is called basis risk. So let's just go through those three types of risk and then we'll finish this video. Liquidity risk is the risk that a transaction cannot be made due to lack of funds or insufficient buyers or sellers. So those two types we called funding liquidity risk and trading liquidity risk. Funding liquidity risk is the risk that usually it's a corporate treasury, cannot meet its commitments. A corporate treasury manages the balance sheet. It has to invest the assets to get a return. It also has to deal with paying off liabilities. And it may be, for example, an example of funding liquidity risk is what we call a funding gap. A company has a sequence of loans usually, and a loan may be expiring. And so in order to pay off that loan, because it's reached maturity, it needs to take out another loan, which may be a 10-year loan or something like that. And if it can't manage that 10-year loan, or it's very expensive, and so they take a loss on a much higher interest rate, then that's called funding liquidity risk. Trading liquidity risk is the risk that there aren't any buyers or sellers in the market. And so I can't, for example, sell some very esoteric company bond on the Indian Stock Exchange, for example. I might look at the electronic exchange and find that there are no buyers, there are no sellers in the what we call the limit order book, which stacks up the buyers and sellers at prices the buyers will be willing to buy below the ticker price and the sellers above the ticker price, and you stack them all up. And if you get a very steep either side, the buyers and the sellers, that's a very deep market, as you can see, because you've got lots of buyers and sellers. But if there aren't any, the limit order book is very, very flat. That's called an illiquid market. So it's all about the market depth. And also recently, you can see how deep the market is by looking at the trading volumes. Maybe they have that share has not been traded for weeks or months. Operational risk is the risk of loss associated with non-financial matters. And we tend to look at two main categories: the high impact, low frequency risks. These are events which rarely occur, low frequency, but when they do, they have a tremendous impact. So this includes cybercrime, terrorism, fraud, things like that. Although cybercrime has become more and more prevalent recently, we still categorize it as a high impact operational risk. The Jaguar company, for example, had a computer hack which is costing its millions. It's had to stop operations, and everywhere down the supply chain has been affected. And then there are the lower impact everyday risks. There could be IT systems going down for a few hours, or something in transaction processing that there's an error there. Usually they're few and far between now, but it used to be very common transaction processing, but now it's more fully automated. But anyway, these risks are usually provisioned for. You don't have to have extra capital requirements. You do for the high impact, low frequency operational risks. That was part of the Basel 2.5 Accord, which we'll deal with at the very end of this module. But for the everyday risks, companies normally just provision in their budget to cover losses due to system downtime, for example.